the IPCC report, the Intergovernmental Panel on Climate Change, which was published in August and will form the basis of negotiations at the COP26, highlighted that scientists now believe that human activities are the key cause to climate change. In 2019, carbon dioxide concentration levels were the highest for 2 million years. In August this year, Spain recorded its highest temperature at 47.2, and Sicily recorded 48.8. This chart, which is in the report, is a really good illustration as to where different countries are at different stages of achieving the UN Sustainable Development Goals by 2030, net zero by 2050, and limiting global warming to 1.5. Those that do will be well positioned to achieve climate resilient futures. However, if we carry on as we are today, we will become climate unsustainable. So the report also highlights the need for more corporate responsibility. Companies will be encouraged to increase efforts to become carbon neutral and also to launch their own green initiatives. In our recent survey that we undertook with the Pensions Age this summer, 65% of pension schemes recognised that managing climate risk is a key factor for them. So the UK pensions market, we're the third largest in the world, with approximately 2.5 trillion of assets under management. We invest in a lot of companies, and we're therefore in a very unique position to drive change. And we can help do this through active dialogue with our asset managers and through measuring and monitoring the carbon emissions in our assets held in both pooled and segregated portfolios. So I'm now going to hand over to Chandra so he can actually give his view on what he thinks the risks are to pension schemes. Over to you, Chandra.
Thank you very much, Pat, and thanks to PLSA and CACEIS for the opportunity. As Pat highlighted on her previous slide, there is clearly growing urgency on climate change and the threat of it becoming a critical systemic risk. Now, the IPCC and IEA reports have talked about global warming with no action potentially leading to a temperature rise of 3 degrees plus by 2100. And these are actually substantiated by a lot of scientific evidence in terms of the last decade being the hottest in the last 125,000 years or even longer. That most of the climate change being attributed to is human-made and is the specific cause of weather events that we've been experiencing recently. And there is also a narrowing range of warming responses to GHG emissions, which means the certainty around climate risk being a systemic risk is actually growing. So with all of that in mind, what does this mean for the financial system and what does this mean for pension funds and trustees? If we can have the next slide, please. So in terms of climate risks, they affect global corporates and sovereigns, especially in high emission sectors and high emissions countries. So you're talking about oil exporting countries, you're talking about countries which use coal-fired power generation, countries which are generally laggards in energy policy, and the same holds for a lot of global corporates within those countries and multinationals as well. So for pension funds and for investors and trustees, this directly affects holdings in equities and debt in these corporates and sovereigns. The global financial system, which includes mainly banking and insurance, is linked to these high emission sectors and countries mainly through the business of lending and insuring both credit and equity risks in these sectors and these jurisdictions. You have shares, you have bonds, you have project finance, asset finance, all of which are instruments, financial instruments, which fund the high emission sectors and countries and contribute to systemic risks for asset owners. So just to put some numbers onto it, Carbon Tracker estimates show that this amounts to about 18 trillion in global equities, including corporate sovereigns and the financial system. It's about 8 trillion in global bonds and about 30 trillion in unlisted debt, which are quite staggering numbers. And all of these link to high emitting sovereigns, sectors, companies, and the banks and insurers that fund and insure them. So if that's not proof enough, as far as the numbers above are true, it's highlighting that climate change is in fact a material financial risk, and by that token is also core to fiduciary duty and needs to be accounted for in investment decision making by trustees and investment managers. And I will pass it on to Pat again to emphasize the importance of taking action and how.
Thank you, Chandra. That gives us a sense as to how you're looking at climate risk. So thank you for that. So this is where it becomes interesting. So despite the fact that pension schemes understand and are focusing on managing climate risks, as I mentioned on my earlier slide, the perception of the impact of climate risk is misaligned. So in our survey this year, we asked the same question that we did of our survey last year. What impact do you think climate change will have on your scheme investments? And the results are very similar. And in fact, 70% of pension schemes are actually saying that they only believe that climate risks have a low or medium impact on their investments. I'm going to hand over to Ralph in a moment to actually discuss the different types of risks in more detail. But at a very, very high level, you could have a company that's reliant on crop yields, or a company that's based in an area that's exposed or prone to flooding. And these companies will have to make large capital investments to protect and manage their operations. And bring this a little bit more to life, to some more numbers. And according to State Street, 60% of the S&P 500 and 40% of the S&P 1200 Global are exposed to physical climate risks. So I'm now going to hand over to Ralph, who's going to bring a more scientific view to this educational session. Over to you, Ralph.
Thank you. So the risks that conventionally people talk about, we had already mentioned, is sort of split into physical risk and the transition risk. I'll start off with the transition risk. So the transition risk is about the energy transition which will happen, and the risk is to do with how will your companies and your portfolio deal with that transition. But I think it's worthwhile maybe breaking it down, the risk, into maybe 4 relevant components, just to make that a bit clear what we mean by transition risk. So the first thing is the risk due to change in policy. So that would essentially be that you have a company that is just at the wrong end of the policy, or that has to implement policy in a way that is costing. And the policy trajectory, we're in the month of COP coming up, the trajectory of policy is clear. There will be more regulation. So the cost of business will go up. And the concern with policy is particularly that policy could change quickly. And people call this disorderly transition. So if there is a sudden political shift and policy shift, companies are not prepared, and then they are effectively flat-footed, and then you could end up with, for example, stranded assets if you're a fossil fuel company. If you're assuming everything's going to go slow and steady, and suddenly things happen quickly. So policy is a risk, and that policy goes a lot quicker than any of you think, and it has been. I think if you told me 10 years ago it would be illegal to have petrol cars in the UK by 2030, I would have thought that seems implausible, right? So things can happen a lot quicker than you realize. So that's the policy risk. Reputational impacts. So this is to do with whether or not shareholders want to be associated with companies, and whether there is increasing pressure to disinvest from certain activities. So, and is the company itself meeting sustainability goals? Is it in the crossfire? So there's the reputational risk, and that can also go very quickly and rapidly and disorderly. So that is a risk. There are general market preferences, which of course is the market cycle, so that sort of comes and goes. But there are definitely preferences. So at the moment, there's a strong preference for anything labeled or approximately labeled as ESG, whatever that means. So there are what you call preferences. Let's call it preferences, not fads, but let's call it preferences. And certainly pensions like to be in the long term, but who knows how long the short term is. So if you're in the wrong part of the preference cycle, there is a definite risk there. Finally, also extremely important is technological disruption. So universities like Imperial College, all of the universities are working hell for leather on innovation. And inevitably, and there is huge amount of government funding, philanthropic funding. So innovation is happening at all levels, and technological disruption can be fully expected. There's a premium you might want to attach to certain companies, carbon premium. However, all of those prices and premiums will be regionally specific. So in some countries, they will apply a different price to others. So it becomes very segmented, very problematic, and very dynamic. So it's a moving feast. So I think that sort of paints the picture, I think, for the transition risk. So the physical risk, next slide. So this is quite a busy slide, but that's the only one I'm going to talk to. So I think to some extent, this slide, in my mind, captures a lot of the essence of climate change. So the title of this is about extreme events, and I focus on extreme events because they're actually the ones that are the most problematic for companies and the funds you hold. And the essence of the message is that the uncommon becomes common. So how do we get there? So what I'm showing you here is a probability distribution. So the y-axis is just the probability of a certain temperature happening, and the x-axis is the actual temperature, and you can see the label cold, average, and hot. And so you've got basically, let's assume a normal Gaussian bell curve, so a standard probability distribution. So you have an average, which is bang in the middle. That's what happens most of the time. Sometimes it's cold, sometimes it's hot. Now, when we do this probability distribution, we actually take out the seasonal cycle. So actually, it can be a cold July or it could be a cold January. I'm sort of taking that off. So I'm saying it's 2 degrees colder than it should be in July, or it can be 2 degrees colder than it should be on the 1st of January. That still goes into the cold tail there on the left. So my average is just what I expect in the season, and the extremes on either side are sort of what we call the anomalies. And see what you see from the distribution, then generally you sort of have this bell-shaped distribution. And the key point about climate change is that this distribution then shifts. And the way we perceive the shift is 2 ways. First of all, we're sort of stuck in this middle bit there with the arrow and the top bit, and I call this the adapted zone. So this is your average temperature. So this is what we're used to. So we're used to having fluctuations around the average of a couple of degrees, and this is why for a long time people thought, well, what difference does 1 degree, 3 degree warming matter, right? So on a day-to-day basis, 1 or 2 degree differences on a day-to-day basis don't make any difference to us. We're fully adapted. Everything we design, build, our clothes, our way of living is fully adapted. We know it's January, we prepare for January. We know it's July, we prepare for July. And if we shift the January temperatures just a little bit, or July temperatures just a little bit, doesn't matter. And that's what I call the adaptive zone. So that's what we experience most of the time. And we really, therefore, not really bothered about the weather. We don't really care, which is where the complacency comes from. Now, if you look at the tail, though, if you go to the right side, the hot as an example, what happens then is what we perceived as hot. So the dashed line would be the hot. So in the past, we sort of would have picked up those things. So these would be, even from our own memories, that, oh, those are really hot days. And just by shifting the distribution, suddenly those hot days become a lot more common, maybe 3-4 times more common. So that's sort of in the regime where we sort of pick up things, we notice things and think, oh, wow, that's happening a lot more frequently. It's sort of just at the edge of the adapted zone, so it's not really causing us headaches. But it's something we pick up, and all of us have, starting to know this. Where's the snow? Where's the glacier? Where's all these things? So that's the first bit. And then to the far right is where the real problems are, and this is what I call the unseen. So if you look in that tail there, you're sort of looking into the margins, into the shadow. You can't even begin to see what's going on there. And that's partly because we haven't gotten any data. So there's a very few events. They're extremely hot. They're what happened like in Canada. We suddenly end up with 6-7 degrees above normal, and they are unseen. So we have no experience about them. We know statistically that they happen. And the problem is, if we shift the distribution, as we know we are, these unseen things suddenly become seen. So suddenly you see them. And we're dealing then in a space there where we have very little data, we have very little experience, we have models, climate models that just can't deal with it very well, and yet the probabilities have exploded. If you look at the y-axis there, it's sort of invisible probability, hardly ever likely to happen, and suddenly becomes measurable.
So we just heard everybody from two experts as to why it's important for pension schemes to take action. And, when I come to this slide, why do we feel an independent view is important? Well, really, it's quite simple. I think from good governance, I think from the ability as a pension scheme to understand the actual risks and to then manage them. Unsurprisingly, a lot of pension schemes are still very reliant on their asset manager or their consultant and helping them verify and manage their climate risks. And only 11% at this point in time are actually independently verifying the climate risks, majority being the larger schemes. So why is that? So in our survey, one of the results that isn't on the slide is that 42% of pension schemes feel that one of the biggest challenges is good quality data on both ESG and climate risks. So not a surprise there. And that's probably why so few schemes are actually undertaking independent verification.
So now that we have a better picture around climate risks and its potential implications, let's see what all the fuss is about around net zero and why there is so much push to focus on net zero. And we'll talk about our thoughts overall and then get into what Grantham has done in our net zero roadmap going forward. So net zero effectively refers to the balance between GHG emissions, greenhouse gas emissions, which are produced and which are removed from the atmosphere. So netting out to zero at some point in the future. Now, it has been legislated by the UK to have net zero by 2050, and at a certain intermediate level, I believe around 78% by 2035. But what does that mean for asset owners and investors? What that means for us in our simple minds is, let's understand the emissions footprint of our investment portfolios as asset owners. What that means in even more simple terms is, let's understand our exposure to high emissions sectors, high emissions geographies, and put it in context of our strategic asset allocation. How much do we have in public equities? How much do we have in bonds? How much are we exposed to energy, utilities, aviation, transport, those sectors? And for investment managers and trustees and asset owners to get a handle around how their portfolios are structured from an emission standpoint. The second bit is understand how this emissions trajectory is going to evolve over time. So the higher you are exposed to some of these sectors, there is a possibility that your trajectory is potentially going to be significantly higher or will be increasing over time instead of decreasing as well. So let's try and understand that. And the third bit is, let's try and figure out how to reduce it over time. So we have more details around that bit in the next slide, but those are really the three building blocks: understanding the emissions footprint, understanding the forward trajectory, and figure out how to reduce it over time. So with Railpen's net zero plan, we've tried to break it down exactly with those in those simple terms, saying we start with a set of baseline emissions, which is covering it for not our entire portfolio, but majority of our portfolio, which is public equities and fixed income. Then looking at interim targets, which are 2025 and 2030 targets at 25 to 30% lower targets from baseline, and 2030 targets, which is about 50% lower than baseline, and then focusing on the long term, which is the net zero emissions by 2050. In all of this, our focus is on real world decarbonization versus just on portfolio. We'll touch on that a little bit more on the next slide as well. The idea is we don't just want to be selling from our portfolios to others who will own the same thing. That's not really, in our view, making a difference to the economy as a whole. Instead, we would like to engage and align ourselves to a reducing carbon footprint over time with our portfolio. So with a lot of funds asking, okay, what happens if they don't commit to net zero? We don't have the resources, we don't have the size, we don't have, and there are so many complexities. The one thing I would say, I agree with all those challenges that exist today, and we as an institution have faced it and continue to face it as well. And we're facing up to it, I'd say, on a daily basis and tackling those. I would say for funds and asset owners, it is really a lost opportunity if you don't jump and start tackling climate change today. Because for the first time in history of investment funds and of policymakers and governments and regulators, they're all aligned to one single goal of reducing emissions, which hasn't happened before in my limited experience in the past anyway. There is a huge pool of resources in terms of climate research, frameworks, methodologies. As Ralph mentioned, a lot of scientific research going on in terms of technologies, both to decarbonize and both in terms of a growing pool of investment opportunities as well, in terms of what you can buy and what you can invest in renewables, energy efficient technologies, solutions. And there are collaborating organizations out there which are doing a lot of good work.
I am a trustee of a small DC trust-based scheme. It's very small in comparison to Railpen. And we have actually implemented our own framework. And where did we start? So first of all, I think it's really important that we just develop our understanding. And that's what we did as a board of trustees. We really sat there and looked at each other and said, well, what can we do? So we got some training and we started to understand, climate risk. So that's what we did at the beginning. That also helped us develop our SIP, which we kept very simple because we're a small scheme. So we knew there was only so much we could do. And then what we did is we screened all our assets, which are held in pooled funds. So I want to state this, that held in pooled funds. So a lot of people say, well, how can you do that? Well, we used an ESG and carbon reporting tool that allowed us to do that. And that gave us look through, like I said, into the underlying companies. So for example, we had the carbon footprint of the companies that pooled fund was invested in. All of the companies, not all of them, around 60 to 70% of them. So it gave us good insight. And this was rather than just going with an overall rating on a portfolio, really understanding what were the individual risks within the pooled funds. So this then allowed us to have a robust discussion with our asset manager. We actually had a better understanding after that discussion around engagement, how they were engaging with companies, how they were encouraging companies to decarbonise, and also how they were monitoring and analysing those risks on an ongoing basis. So I completely recognise as a trustee of a small scheme that it's not perfect. And even the DWP has stated in the new TCFD regulations that it is as far as we are able. However, we feel as trustees of a very small scheme that we're undertaking our fiduciary duty as far as we are able, but also doing our bit to drive change, which we think, again, pension funds are in a unique position to do so.